Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the Portfolio Manager of the Granny Shots US Large Cap ETF. This is our weekly video update for the week of March 2nd. Before I dive into the content of the video, I do want to give you some particulars. The price of the Granny Shots ETF as of February 28th is $19.53. The net asset value is $19.54. And total assets are $898 million. It's been a rough week. The S&P was down 1% over the past 5 trading days, and the Granny Shots ETF is down 2.74%, which means the Granny Shots ETF underperformed by about 178 basis points. This is the performance of those holdings sorted by the past week from best to worst. And the top 5 performers over the past week are names like Progressive, Axon Enterprises, Abbott Labs, GE Vernova, and Bank of New York Mellon. The bottom 5 performers are names like Palantir, MicroStrategy, Tesla, AMD, and NVIDIA. Here is a snapshot of the performance by theme. And as you can see, energy and cybersecurity has underperformed the market the most, or the largest contributor to downside. And here you can see that millennials are actually the most positive contributor to relative performance. Here are the holdings of the Granny Shots that fall within the millennials category. So it's names like MicroStrategy, Costco, Abbott Labs, Microsoft, Google, Garmin, Apple, Meta, Amazon, JP Morgan, Tesla, PayPal, American Express, and NVIDIA. So I thought it'd be useful to talk about millennials because the question would be, given markets are worried about tariffs, does this change our thesis around millennials? So let's just go over some basics. First of all, millennials are the largest single generation born ever, representing roughly 96 million people at the peak, and that peak should be around 2038. You might wonder, why are we saying the millennials will keep growing in size? And it has to do with immigration, that as long as there's positive inflows of people that are born between the years 1981 and 2000, the millennial cohort will still grow. And people roughly age 30 to 50 represent the prime aged workforce. And this chart, which starts in 1935, shows that the number of people aged 30 to 50 actually does move cyclically. And it's really driven by generation. So the bottom here in 2009 was the start of the millennials turning age 30 to 50. And this is helping contribute to a rise in the number of people aged 30 to 50. Now, you might be wondering, does this matter or have any significance? In fact, it does. For instance, take a look at 10-year rolling core inflation, and you can see that this is roughly correlated to the number of people aged 30 to 50. Why is this happening? Well, we've talked about this in previous pieces, but basically, according to the Urban Institute, and this is their data, the individual, like a single person, their borrowing rises between the ages of 30 and 50. So this is median debt balance, and you can see it rises in that 20-year period. So in other words, the more people age 30 to 50, the more people that are going to be borrowing money. In fact, as you get older, you can see that debt leverage actually starts to decrease. This is evident because when you start turning age 30, you start making more capital intensive decisions. For instance, buying your first home, maybe buying your second car, and your income is rising as well because you're entering your prime income years. And that's what's illustrated on this chart. Well, this has significance because between now and the end of this decade, millennials are going to be the largest buyers, because they are this generation turning age 30 to 50, of many products. They're going to be 33% of consumer spending growth. They're going to represent 98% of all the children born. They're going to represent 44% of the cars purchased by the end of the decade. Now, of course, that means they are sensitive to tariffs. So that is something that we asked ourselves. And they're going to represent 40% of all homes purchased. But that means they're really more sensitive to interest rates. And I think this is what you have to keep in mind. If we had to look at what's happening in the economy, interest rates have fallen because of these tariff concerns. And of course, tariffs are raising the risk of consumer prices going up. But actually, I might say that at the end of the day, it's probably more important for millennials that interest rates are falling, not tariffs. And so in some ways, I think as much as the market is all concerned about tariffs, it is a bit short-sighted. Let me just give you some things to think about. If you look at disposable income growth for millennials between now and the end of the decade, it's growing at roughly 9% a year. That's twice the rate of the overall consumer. Consumer spending by millennials is going to grow 9% a year. That's twice that of overall consumers. And in fact, their savings flow, or how much money they save, is growing at roughly 10% a year. And again, that's twice the rate of overall consumers. And if you look at financial services specifically, millennials are going to be 72% of all spending growth, whether that's insurance products, mortgage, interest rates, charges, vehicle insurance, contributions to their IRA, vehicle rentals, people paying finance charges on those cars, and life and personal insurance. So you get the picture. Basically, when it comes to financial services, the millennials are the most important consumer right now. And that's something to think about thematically, that before there were millennials driving the economy, it was Gen X driving the economy. And before Gen X driving the economy, it was the baby boomers. And this chart really shows you the importance of really betting on that particular generation when they're age 30 to 50 and what they do. For instance, in the run-up from 1980 to 2000, if you bet on what boomers were buying, which were consumer stocks, you can see that you had an 1,100% return buying the consumer stocks versus a 16x return on the S&P. And Gen X, which was the internet generation, buying the internet-related stocks gave you a 16 times return compared to a 3.6 times return for the S&P. So again, betting on Gen X and what they liked was very profitable. Well, we have to now posit the same thing. Millennials are going to be really in charge of markets until 2038. And so you want to buy what millennials are interested in. And that's why we have this list of stocks that we think are highly leveraged to the habits of millennials. Now, I want to sort of step back and say, you might be thinking that there's a lot of turmoil in markets and this is just too much heat. And so you might want to actually just get out of the market entirely. And of course, granny shots are not immune to that turbulence. But there is something to keep in mind, which is the rule of the 10 best days. And it's a year. And if you didn't own the markets in the 10 best days that occur in that year, in any single year, your annual return drops to minus 13%. That's a staggering difference, 8% versus minus 13. This is even true over the past 10 years. Since 2015, the S&P's returned 12% a year. But if you actually didn't own it during the 10 best days, your annual return drops to minus 10%. That's 2,200 basis points. So the whole point here is you don't want to time the market. And here's the last 10, 15 years or so, the S&P. And as I mentioned, it's averaged 12% a year. But if you exclude those 10 best days, your average returns drop to minus 10%. And just look at the last 2 years specifically. Here is the last 2 years, 2023 and 2024. If you look at the return of those 20 best days, the 10 best days in each year, that is accounting for 20% gains. So in other words, the fact that we were up 20% really is attributable to those 10 days. And if you didn't own those 10 best days, the return of the other 355 days is only 4%. So that's how you get to a full return of 20%. So in other words, last year's 20% gain, 2023's 20% gain came down to 10 days. And And finally, I just want to remind you what a granny shot is. It is named after an unconventional way to throw a free throw, popularized by NBA Hall of Famer Rick Barry, who made 90% of his shots. It may not look as cool as doing overhand free throw, but you have better success. And we implement a granny shot by looking at longer term themes. I talked about millennials today, but the other ones are global labor suppliers and the rise of AI and automation, energy and cybersecurity, as well as easing financial conditions. And we have shorter term themes that we do revisit every few months, like style tilt, seasonality, and the fact that the PMIs are finally above 50. But to be a granny shot, not only should it be in one of these themes, it has to appear in more than one theme. And the stocks that appear most often are really the most granny of the grannies. This is all available and you can find on our fact sheet at our website, grannyshots.com. And this is the investment team. Thanks for listening, and I'll speak to you soon.